We want to talk markets. We do that with David Kudla, CEO and Chief Investment Strategist for Mainstay Capital Management. They have about $3.7 billion in assets under management. He joins us on the phone from Michigan. And David, Matt was mentioning earlier, you've got quite the Twitter following. When you promote yourself, and folks, they just kind of are all over it on Twitter. So we appreciate the good Twitter game there. David, so let's talk these markets here. We just got through a pretty amazing earnings cycle here, where just extraordinary year-over-year gains in net income and earnings. Was that enough to satisfy the folks that may have had some concerns about valuation in this market?
I think it's helped considerably with valuation, right? So we started the year at a PE, we were looking at PE about 22.4, and that's actually improved by 6 or 7% or come down a little bit, as we've had these just stellar earnings come through in the first and second quarter. You know, we had the S&P 500 company profit margins at their highest ever for the second quarter, and, you know, just these other great statistics on beating expectations. Earnings have been magnificent. So I think that helps with valuation. I think that part of the acceptance of valuation in the 20s, where we've had PEs in the 20s that have been right before the onset of a major drawdown, like in 2008 or in 2000 to 2002. So, but we are in this period of still ultra low interest rates, not just on the short end of the curve with the Fed, but through the rest of the curve as we sit here today.
But are you worried, David, about some of these things peaking, prices, earnings growth, valuations, margin expansion? Are we at a peak?
Yeah, that's our fear going forward. As good as everything has been, we probably are. We're just not going to get obviously not going to get the kind of year-over-year earnings improvements that we've had going forward, comparing it to, the quarters of COVID last year. We have concern about our peak growth, and when I say that, I mean peak growth rate, that we see our rate of growth slowing going forward in the forward quarters. So we do have that concern that from looking at the economy, at least looking at the economy for just the stellar numbers at earnings, it's going to be tougher going forward.
So that kind of brings up the question for folks that are in the equity markets: do I want to be exposed to more cyclical type of sectors that maybe performed really well over the last year, a reopening trade, or do I want to say, okay, growth may be slowing, I need to focus on the proven growth stories that have gotten me this far over the last decade or so, the Amazons, the Apples of the world? How do you think about that rotation?
Right. So we've been playing, I guess you could call it a barbell strategy, or two themes this year, a rotation back and forth between growth-oriented stocks, specifically technology, the mega caps, and then the cyclical plays or the reopening stocks. We still like the reopening stocks, the cyclical plays in the large cap arena, and that's probably our biggest from a market capitalization standpoint going forward. We see small cap stocks do well in the early stages of a bull market. We're doing quite well this time last year through the end of the year, and later we want to move towards quality, growth at a reasonable price, large cap names. So in the cyclical area, we are with large cap names. In growth, we like mega tech. But a third area that we've moved into, because of these concerns about the economy and markets going forward, setting high after high for the market indexes, is to look at defensives. And the last time when I was on the show about a month ago, we had talked about medical technology and devices, Fidelity Select Medical Technology Devices, an open-end fund that we've recommended. It's over the past week up more than 6% versus half of that for the S&P 500. We also are looking in the biotech area, and as many people thought, the big boost for biotech and for pharmaceuticals happened with COVID. We're now talking about booster shots. We're talking about potential of continuing to have shots more than once a year. But just pharma, big pharma in general, is another area, because healthcare is a defensive sector. We have days where the market is up, healthcare or down. Healthcare sectors are up. So it gives us good diversification, and we think an added tactical opportunity with our concerns about growth and cyclical going forward.
Are you looking for any kind of correction going forward? And do you have a list of assets that companies that you want to own in case the prices go down?
Yeah, we haven't had a meaningful pullback, and when I say meaningful pullback, even above 5% since October of last year. Almost a year we're coming off now. So when we talk about the inevitability of a garden variety pullback at any time, and when I say that, I mean 10% or more could happen at any time, and we're probably overdue. It's probably going to be a function. We get Fed minutes today. We've got Fed presidents coming out a lot over the past few weeks talking about tapering. I think it's yet to be seen, when we actually get tapering started.
Yep.
That's probably, we'll still see that as the biggest risk to the market, along with inflation. But I think that's why it's prudent for investors to think about that defense.
David, thanks so much. David Kudla there from Mainstay Capital.